So our next question comes from Nellie B. Nellie says, I have a mortgage with a 2.6% interest rate. Should I only be paying the minimum amount on that mortgage and using the extra cash to earn interest in a high yield savings account? Or should I make extra payments on the mortgage? Nellie, what a cool situation you're in. Right? Your mortgage interest is 2.6%. I am so jealous of you. The house I'm sitting in right now, I think the interest rate is 6.6. The other house that I have, the interest rate's at like 3.2, 3.3. So it's a world of difference about how much money you're saving here with this interest. And there's so many people out there that are so jealous of your situation. So congrats on being smart about buying a home. So what Robert and I teach is that we want to have arbitrage with our money. Right? We want to be earning as much money as possible. Now, let's take two situations here. Situation one is you owe $300,000 on this mortgage at 2.6%, and you are now making extra payments month after month, year after year, and you eventually pay off this mortgage at a 2.6% interest rate fast and furious by paying off an extra $300,000 ahead of time, right? Awesome. What does that mean for you? That means that you are no longer paying 2.6% interest on your $300,000 debt. Now, to make sure that we're on the same page about those numbers, that is $7,800 a year that you are saving in interest. Nice. Very cool. Okay. So what's the alternative? The alternative is we make the minimum payments on the mortgage and we take that extra cash and we invest it in the stock market. Now, just to give you guys some real numbers here, the NASDAQ 100, defined as QQQ, total performance year to date, right now as we film this at the end of July, is up 10.83%. So let's assume you had that $300,000 and you invested it at that 10.83%, well, you would now be up $32,490, which is materially more than the $7,800. So in my opinion, I would much rather have my money invested for me in the markets and working than saving me $7,000, $8,000, $9,000, $10,000 a year in interest. I would much rather have $30,000 than $7,000. So that's how my math checks out. That's what the arbitrage is that we're trying to explain to you guys, right? You pay $7,000 to make $30,000, right? That's how you guys should be thinking about it. But Robert, I'll let you fill in the gaps that I'm sure I missed.
Yeah, I think you just absolutely crushed it. And it's this simple. You have to ask yourself, if I can make 10% with my money if I invest it, but I can pay out 2.6%, then you're going to keep that 7.3, 7.4% in your pocket rather than paying off this low interest debt. Number one, that is it. That is the basics. If you can make more with your money than what you can pay on borrowing money, you always borrow money. That's where the positive arbitrage comes from that goes into your pocket, whether it's short-term or long-term. Austin, I think it was a great breakdown giving the actual numbers, but that's the simple, easy way to calculate. If I can make more over here with my money than what I can borrow for, you always borrow. So please don't make extra payments. Don't try to pay it off early. You are in an incredible, incredible spot. And by doing so, you have all this extra money growing and compounding in your accounts rather than you taking all your money to pay off this low interest debt.
And I want to just linger on this a little bit longer because there's a big difference between simple interest and compound interest. Whenever you have a debt like a mortgage, it's paid for in simple interest. Let's say, for example, this $300,000 that you owe at 2.6%, $7,800 of interest that you pay that first year of having it. But you've been making payments and maybe your principal goes down to a $290,000 or $295,000, whatever it might be, right? So let's call it $295,000 that you now owe the next year on your mortgage because you're making these mortgage payments. Instead of $7,800 of interest you owed, now you owe $7,670. And the year after that, the interest you pay is $7,430. And then after that, it's $7,200. So it goes down in a linear fashion. Now, there might be a different amortization schedule where the interest might go down faster, slower, whatever else. Like, we understand that. But what people forget about is that interest and debt can only go to zero. Investments theoretically could go up forever. And the rule of 72 tells us that stocks double every 7 years. The stock market doubles every 7 years. That's history and that's mathematics. And so, in this situation, yeah, that $30,000 difference that you are making with your money at that 10%. We fast forward 7 years from now, the 300,000 that you had invested originally is now worth 600,000. And then that's now worth 1.2 million. And then that's now worth 2.4 million. But you are just saving $7,000 a year in interest. So it's like, would you rather have, 7,000 of savings or potentially millions of dollars throughout your life, right? That's how you should be thinking about investing. We made a whole episode about this, talking about how to 70x your money, understanding the opportunity cost of not investing early and often, and just all the fun stuff about compound interest and really trying to think about that. So if you've not yet listened to that episode, please listen to it. It is a banger of an episode. But compound interest, I'm telling you, what's that quote, Robert? Those that understand it earn it. Those that don't pay it.
Yes, 100%. And it's just really important for everyone to understand the point you just made, because so many people think that debt is bad. And debt is not bad. The wealthiest people on this planet use debt, but they use it to their advantage. They use it for leverage. They borrow money in an inexpensive fashion with low interest rates, and then they use it to make more money. So when you're in a situation like this person is right here, it is just so incredible, and you have to understand, keep making the minimum payments, you're going to crush it, and keep building your portfolio, and you will have a great retirement down the road.